Portfolio Builder members, welcome to our Tuesday Trade Alert where we play the Emerging Markets ETF EEM. Just do a quick audio check, make sure everybody is getting this content, and it looks like we're working, so that's good to hear. Big news tomorrow is the Fed is expected to drop interest rates by 25 basis points. We already have Trump railing on them this morning. We'll take a look at the topical news in a minute. The other big topic will be what they're going to do about overnight lending markets. The banks have ran out of cash. They are no longer able to take advantage of the overnight lending market, and this is causing a lot of trouble all around the world from every little bank who needs to borrow from the big banks. So it's expected that in the near future, the Fed will actually expand its balance sheet with a one-time injection potentially of $300 to $500 billion to give some more cash into the banking system to free up liquidity problems. Let's just take a quick look at our Tuesday trade, how that has resulted in a profit today, and then we'll take a look at the topical news that is affecting our trade alerts. Okay, so last week we continued the long emerging market trade. We've been long emerging markets for 2 weeks ever since the unexpected phase one trade deal announcement was released. I was actually positioning our clients for bad news to come out of that because leading up to that we'd seen the Chinese buying agricultural products, but on the other side the administration was doing a lot of mean things towards China, including talking bad about them at the United Nations, sanctioning 17 more tech companies, and even recently we've seen Pence go up there and bash China. So questionable if we'll really get this phase one trade deal, but the narrative continues that they will sign a deal in mid-November. So we'll take a look at that. Here's the previous trade alert, and you can see we've been playing the theme of low interest rates despite all the problems in China. If we do get a phase one trade deal and we have massive dovishness with central banks around the world, it just won't matter what's happening on the underlying economies. This will push asset prices higher. And the only thing that will most likely pop it if we don't have friction between US and China will be runaway inflation like we saw from 1965 through 1980. Where Volcker had to hike up Fed rates all the way up to 20%, which was complete insanity and gave you a 15-year bear market in stocks and bonds. So we'll cover that more in our webinar Thursday. But for now, we're going to play this bubble, the direction that everything is headed, which is up. So let's take a look at the previous trade. And again, we're calling this the classic smash and grab trade. Emerging markets have been smashed from about 2 years of tough administrative sanctions and tensions, tariffs, all sorts of negative news towards China, which is the key player in emerging markets ETF. Just to get back to the 2017 high, we're looking at a 20% return on this ETF. And meanwhile, on our SPY trade, I'm looking at more like a 10% run up until I think we will really max out the potential run-up from a phase one deal. Now remember, after that we got to worry about a phase two deal. Let's just take a quick look at the trade alert from last week to this week. We can see emerging markets were trading at 42.46, and we opened this option collar that is somewhat loose. That means we can profit from the underlying asset going up, and we're not trying to profit from a flat or down move with this setup. We sold the 43.50 call, brought in a credit of about 5 cents, and then we purchased the 41.50 put. So we give up profits after emerging markets ETF EEM goes over 43.50. And on the same breath, if something bad were to happen and emerging markets crashed, we'd walk away with a minimum of 41.50 per share because we're long the put. So we collected a credit on the call, and then we paid a debit on the put. Let's review what happened today. So week over week, the ETF traded from 42.47 to 42.80 for a 33-cent profit. The option caller cost a debit of 7 cents to open, and 2 cents to close for a 9-cent loss. That ate up just under a third of our profits, but that's perfectly fine with our strategy because we're going for income and safety and not growth or speculation. So we're able to generate profits with much less risk and much less volatility than other investors who are trying to do buy and hold strategies. Now our net result was a 21-cent profit per share on 3,800 shares, or a $798 profit. If we scroll down, now I do highly recommend, of course, that you watch our daily video. That's the link up here. But I try to sum up the key points in the alert. So we'll start off by reading the alert, and then we will dive into all the news and clips I've collected over the past 24 hours. So Fed is highly expected with a 90% probability to drop rates by 25 basis points tomorrow and to potentially expand its balance sheet. Now, it's already expanded that balance sheet by $200 billion and said, whatever you call it, don't call it QE. So they're now calling it the organic growth of the balance sheet. Meanwhile, we're waiting to see if China will follow suit. They're having a key meeting this week, actually. And what we've seen so far is them dramatically drop their loan rates, as their economy is certainly in some trouble right now. But the big picture is 80% of all central banks around the world are aggressively cutting rates and printing money. So this is propping up markets and inflating the bubble even larger. So what do I expect will happen from the Fed announcement tomorrow? I'm not expecting any huge fireworks. I do think that the dovish Fed, and I don't think it's going to be a super dovish Fed tomorrow. I think they're going to say things look good in America, but we're worried about the slowdown in China, and that we're going to do this one more rate cut and then pause and see what happens. I think that's what you'll see. Maybe some language about providing some liquidity to the banks who are strapped for cash. So I expect our GDX and TLT position to have limited drawdown from this catalyst, maybe trade flat, slightly up. But I think the bigger catalyst will be a slow, gradual melt up in the SPY and emerging markets ETFs leading up to that November 15th phase 1 trade deal. So this is a good setup for our long bond, long stock strategy currently, as we're in a phase of lowering interest rates in the face of a global slowdown. Other wild cards that do keep me up at night, I guess you could say, are the impeachment inquiry, which continues to move forward. They're doing some sort of vote Thursday about the procedure for how they're going to do this impeachment inquiry. And if you listen to folks like Steve Bannon, he's actually highly suspected that they will vote for an impeachment by Thanksgiving and try to push us to the Senate by December. Meanwhile, we're seeing some earnings growth start to slow down significantly, and the protests in Hong Kong continue to grow in terms of violence and negative effects to their GDP. And the reason Hong Kong's so critical is because that is the only way China can raise capital to keep this global bubble going. And if China decides to try to reduce its debt obligations and really clean up all this misallocated capital, I do believe we will see a global recession quite rapidly. So everybody's waiting to see if they will follow suit and begin to aggressively ease monetary policy. We'll take a closer look. I also want to point out that there's now protests in Lebanon, Italy, France, Venezuela. It's all over the place. The bottom line is inflation has drove key things like real estate and medical costs sky high, while wages have remained flat. And meanwhile, these Fed central bankers say there's no inflation. So they've been manipulating that calculation so they can keep rates low and continue to support all these credit markets and the banks. Now, so that's the big general problem. I think eventually you'll see the populism start to take over the government and start shifting wealth from the corporations and the super wealthy down to the populace. And so that's something we'll probably watch develop over the next decade as we see this This bubble continued to grow until something pops it. If we look at our returns, we're sitting on a 15% total return since December 11th when we started all this up. I want to point out that our goal is not to outperform any other strategy out there or the S&P 500. We have a very clear goal, and that's to generate a 1% return per month with very little drawdown. And the key to doing that is having a very equally weighted ratio of stocks to bonds so that when one goes down, typically the other will support the portfolio. And so you can see we've done significantly better than the SPY ETF when it's had large pullbacks. So I do want to note in December, the SPY had a 15% plus decline. We had a 1.2% return. In May, the S&P 500 fell 7%, and we had a 2.2% return. And then in August, everyone was caught off guard with the raising of tariffs. On December 15th, we caught a 1.8% return. The only time I've lost our clients' money, I would argue, was a smart move. In July, I was expecting the tariffs to be raised, and we were positioned to not lose money from a stock crash. So it didn't happen in July. We lost 1%. No big deal. It was a smart move. In August, we walked away with a 1.8% return when Trump did come in with those tariff threats. October was the same thing. We had no reason to believe they would come off with the phase one trade deal, big smiles, and suddenly they're going to do business with one another. This is 2 years of them saying this and then it not happening. So I'm still highly skeptical, but we are working our profits back up. Now, October started off with a 1.1% return in the first 3 days, primarily from a jump in the TLT, and then that TLT sold off significantly when they came out and surprised everyone that, hey, everything's hunky-dory, we've got a phase one deal in the works. And that phase one deal continues to whittle itself down to less and less and less. So it'll be interesting if this really does get signed, as we're now 2 weeks away. So my expectation is to see a slow, gradual melt up in equities leading up to that event. And if it really does get signed, significant catalyst to higher levels in equities. But without there being tremendous drawdown in our TLT and GDX. Now, on the other note, if this trade deal does fail, I've been issuing very tight collars on the SPY, our biggest equity position, so that we can have that same sort of result we had in December, May, and August, where the put option kicks in on the SPY, limiting downside risks, and then the TLT has all the room in the world to travel higher and deliver our profit. That and GDX, which currently are quite correlated. Now, if we look at the return of the portfolio 2, you can see it's up 19.6% this year. Had a rough September, but a strong October. And other than that, it's been bouncing around anywhere from 2% to 7% a month with some bigger drawdowns. December, we lost 4%. September, we lost 6%. Outside of that, it's been pretty consistent, higher returning portfolio with a little more risk. So some of our followers do elect to not trade the SPY, so they can just trade Tuesday, Thursday. And I'll show you the allocation for that in a moment. This is what we recommend if you want to follow the full program to get the least drawdown and just aim for that smaller 1% return per month. You have 100 shares of the SPY Monday, Wednesday, Friday, noon Eastern. We issue the trade alert via email and text. 200 shares of emerging markets on Tuesday. 200 shares of the TLT on Thursday. And then buy and hold 250 shares of GDX. Here's the text message we sent out to our members. Buy to close the November 1st, 2019, 43.50 emerging market call. And then sell to close your November 15th, 2019, 41.50 EEM put option. Now just always remember, if your put's ever worth a penny, you can let it expire worthless. No one will want to buy it. But in terms of the short call that we're selling, we always have to close that out. Here's a look at how to get out of that position visually. Buy to close your call, sell to close your put. Super simple. All of our trades look identical to this. And you can see we have now moved up the strikes 50 cents on both sides to the 44 on the call. So this just means after the EEM goes above 44, we do not get to enjoy any extra profits. That's where our maximum profit is reached. And on this same note, if the emerging markets were to sell off because of any type of bad news, we would still get $42 a share, no matter how low emerging markets goes, because we're long that put. So we're collecting 4 cents to sell that call, and then we're paying pretty hefty premium because I'm just concerned if anything goes wrong tomorrow, that could be very negative to the markets. Our TLT is currently right at that put option, so we can't lose any more on the TLT, so that's good news for us. We just got to be a little precautious on our stock position this week due to that announcement. Now, if they're overly dovish, we might get quite a large catalyst on equities, and we might miss out on some of the profits. But again, that's not our game. We're not worried about missing out on profits. We're more worried about realizing large losses because we were taking on too much risk. Here's our risk-reward profile. Our maximum loss will be $90 a contract, or for every 100 shares, our maximum loss this week can be $90, and our maximum profit is $109. So not aiming for a huge profit this week, as we need to see this Fed announcement actually happen tomorrow and dig into the details of it. Do a quick presentation about who we are, and then we'll jump into the topical content that I've collected. And I'll take a quick little look at the chat, see who's in there. Good morning, Ron, Tom, and John. Thank you so much for joining us, and good afternoon, morning. All right, here's a quick little commercial about what we do, and then we'll jump into the topical content. Daily income trade alerts at noon Eastern, Monday through Friday. Here's our breakdown of returns month by month. You can see in December we squeaked out a 1% return. In January, the S&P 500 kicked our butt. We only made 2.2%, but we don't care. February, 1.7. March, 2.7. April, 1.2. We're competing with the S&P 500, underperforming, but again, that's not the goal. Then comes May. Surprise, you get a nasty sell-off to the tune of over 7% drawdown. We've got a 2.2% return. Come June, market flies up almost 9%. Well, we didn't get 9%, not even close, but we made a nice 3.2. In July, we played it safe. There was a critical trade talk in Osaka, and I expected the trade deal would break down just like it has for the past 2 years. It didn't break down. We lost 1%. But if we were right and we had been bullish, we could have seen 5, 10, 15% sell-off in equities. It wasn't worth the risk. So we lost 1%, no big deal. Then in August, completely caught off guard. I did not think the tariffs were going to go up in August. I thought he was going to try to kick the can down the road till after 2020. Surprise, surprise. Tariffs, December 15th and in October. And lo and behold, come October, they delayed the October tariffs. And now we're waiting to see if they'll delay the September tariffs. So in September, the S&P 500 really went nowhere. It flew up, flew down. We squeaked out a 0.3% return. And right now in October, we're down 0.4%. Now that has been working its way up from as low as 0.7%. But we're not concerned, and we've done a good job protecting capital and staying away from highly risky moments when we have trade talks that could break down. So we've reviewed this screenshot of how to allocate a $75,000 portfolio. Let's take a look at this smaller size portfolio, which you can build with only $35,000. It's the same risk profile, but you're playing a more risky asset, obviously emerging markets over the SPY. So you'd have 400 shares of emerging markets on Tuesday and 100 shares of the TLT on Thursday, with 130 shares of GDX. You have that same profile, 50% equities, 40% bonds, 10% gold. Now, this is our setup with the narrative that a trade deal is in the works and that the Fed is going to remain dovish. So if that if either of those break down, we will have to alter our options to profit from different types of moves. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Our goal is income and safety, not growth or speculation. Simplify your holdings, reduce your risk, get better results with less work, and weather-proof your retirement portfolio. And if you haven't joined yet, we have a 40% discount that ends on the 31st. Call Dean at 505-322-7515. You may be getting this video after the bell, which is when the trades are worthless. So go ahead and call Dean if you want to activate your account. And if you're a member and you haven't gained the lifetime access deal yet, call Dean. You can save a lot of money and also get a small trial into our bootcamp program that's about to start. So call Dean at 505-322-7515. And thank you, Tom, for joining Friday. He joined our bootcamp and he's already a lifetime member. So thanks for all your support. We really appreciate you. A couple reminders. Tomorrow we have our paid webinar, which is at 2 Eastern now. I have delayed it an hour from our normal time. And our free webinar is on Thursday at 2 Eastern. So check your email 1 hour before for your access link. Here's our disclaimer. I'll let that stay up for a second, and then we'll jump into the topical content. Okay, so here's what we have right now. We have over in Europe and Japan, they have negative rates. They get paid to borrow money. Don't we have to follow our competitors? Yes, we do. The Fed doesn't have a clue. We have unlimited potential, only held back by the Federal Reserve. But we are winning anyway. And I guess one critique you could put of Donald Trump is that he is a real estate mogul. So of course he likes lower interest rates. Donald Trump, this is from the Chinese media. Donald Trump, Xi Jinping said for November 17th meeting in Chile to sign interim trade war deal. Now the details of this are very interesting and have slowly gotten whittled down to less and less and less. So we'll see what exactly is in this thing. But I think just the fact that they're not trying to antagonize one another, plus we get the dovish central banks around the world. Last thing we really need is the China to print some more money and inject it into their system. And I think we'll see that nice stock rally. Nervous Nancy Pelosi is doing everything possible to destroy the Republican Party. Our polls show that it is going to be just the opposite. The do-nothing Democrats will lose many seats in 2020. They have a death wish led by a corrupt politician, Adam Schiff. Nancy Pelosi, everybody has read your words on the call. The Ukrainian president asks for military aid to fend off the Russian attack. You say, I want you to do us a favor, though, and then you spend the rest of the call asking for bogus investigations to smear your political opponents. Mark Meadows, Republican. We've just learned the House Democrats are moving the public impeachment hearings to the Intelligence Committee, taking it out of the normal jurisdiction, the Judiciary Committee, cutting out GOP members who have spent the majority of time questioning witnesses till now. This is a sham. Over 400 Chinese property developers have filed for bankruptcy so far this year amid tightening government scrutiny, slowing home sales, and a cash crunch. This is over in China. And they actually will force people listing properties for sale to have a minimum price to keep this housing bubble growing. And so this is the big Lehman moment that the world is slowly watching unfold. When will China go bust? Not that they're going to go bankrupt, but they do have to consolidate all this bad debt that's out there, all this misallocation of capital. And when that does happen, there will be a dramatic worldwide slowdown. The question is when. And it was looking like the U.S. was going to pressure that moment to be sooner than later. And then we got the phase one trade deal. So just keep in mind, in our emerging markets position, I will be just as happy to invert our option collar and profit from a downside move if we see things starting to turn the other direction. But right now, because it is down 20% from its most recent high, and we have this dovish central bank move that's not just happening in the US, it's happening all around the world. I don't want to fight the central banks printing money. Now, their last print was 6%. 5 years ago, it was 14% GDP. 10 years, it was something like 30%. It was insane. Got to remember, these guys were going from living in the sticks to suddenly building iPhones and having tons of money pouring into their country, to overtaking Samsung and Apple in terms of the #1 seller of smartphones in the world with Huawei. So they have grown massively and quickly. They subsidize industries. They tax their folks at 70%. Corporate tax rates in China are very, very competitive and very low, which has driven lots of companies to go set up shop in China. And now all of this pressure from the U.S. has a multiplying effect, because if you take away one job, that guy's not going to go have money to go spend to create business in 5 other companies, and then those people lose jobs. So it's a very, it's like a virus effect when we start to apply pressure to someone who's so leveraged, which is China. But now they're saying, this is their China's top state think tank that, everything's going to rebound now, and we're going to go up to 6.1. China's President Xi will attend the second China International Import Expo in Shanghai on November 5th and give a keynote speech, said the Ministry of Commerce. This will be very important to listen to in terms of tone as to how he's going to deal with U.S. and, more importantly, how they're going to deal with their slowdown in their economy. Are they going to print, or are they going to let their economy slow down and try to work off all this bad debt? This is remarkable. For the first time ever, companies missing earnings per share are surging. Now, this is only 0.4, but it is alarming, and we have started to see growth expectations slow down. Now, will that really matter as long as we have a positive environment between U.S. China and all this money printing? Probably not. Ahead of Wednesday's rate cut, this is from Bank of America. Over the past 30 years, the Fed has never cut more than 75 basis points at a stretch without the U.S. economy going into a recession. USTR to consider starting November 1st extensions of certain tariff exclusions on $34 billion of Chinese imports. So now they're talking about starting to delay some of the tariffs that were already delayed. Positive news on the trade front. Jeffrey Snyder is expert in the bond markets, especially the dollar and the euro. He has some interesting slides. He's been posting all these kind of things critiquing the Fed and the banking system without really clearly identifying what his predictions are. He's also been on Macro Voices probably every 2 weeks. So he's got a lot of good insights, but it's not clear what he really thinks is the problem and what his expectations are in terms of how to profit from that. But I'll point out the critiques that he's been putting out. In the U.S. bond market, things appear to be much better. Central banks aren't studiously dismissing all warnings as they were last year. And now the dovish to extreme dovish, the end of the soft patch, or merely the midpoint in the down cycle. Here's a look at the Bank of China's balance sheet, and you can see they have been growing it consistently over the last several decades, and right now we're at a period where they have, in 2018, they tried to reduce debt and their liabilities, and now they're starting to grow it once again. So the question is, are they going to spike their balance sheet once again, provide some liquidity to their banks, to all these companies that are suffering, and prop up their stock market? Or are they going to let this thing deflate and cause a worldwide recession? So carefully watching that. And another look at their assets. They've been letting their treasuries sell off and loading up on euros and gold, trying to remove their dominance on the dollar. And here's their lending rate, which they've dropped almost down to zero. You can see over the last 2 years, from 3% down to 0.5%. So they've been lowering the rates, but they have not been injecting as much capital. Now in the last couple months, they have started to do that. As you can see, this little uptick right here. And that represents several $100 billion that's been flowing into it, but it's nothing like the trillions of dollars they've been adding when you see these bigger spikes. So if they do go for a injection of something more like $1 trillion or more, of course that will be much more effective in inflating these asset prices once again. And so here's kind of the pivotal point we are. Is Powell right? This is just a mid-cycle adjustment because we have such a strong economy? And if so, is everything going to be just hunky-dory now? Or is this a broad worldwide economic downturn? And if that's the case, there's still a lot more room to cut rates. So if that's the case, then they could potentially slow this down to dropping the rates every 3 months. That would give them 7 more cycles, or about 2 years, just under 2 years, to hit the bottom rates of zero. And at the same time, I think they're going to be slowly injecting capital. Right now, they're doing $60 billion a month. We're expecting another one-time injection to immediately free up this repo madness. What's going on in the political spectrum? More and more rumors keep coming out that Hillary will run in 2020. Joe Biden still leads the polls on the Democratic side, despite all the Ukraine-China drama. But I just don't believe he will be the front runner. His performances on stage are really not very impressive at all. And now there's rumors that either Elizabeth Warren or Buttigieg might become the front runner as they continue to push up in the polls. Nancy Pelosi, the House, has been following the facts, and the evidence has only made the president's own words on his call more appalling. This resolution will set up the structure for the next phase where the American people can hear those facts for themselves in open hearings. So that'll be interesting, as they've been doing closed hearings. Elizabeth Warren continues to attack all the big powers that be. Facebook's own employees know just how dangerous their policy, allowing politicians to lie in political ads, will be for our democracy. And so we keep seeing these politicians go run fake ads with blatant lies about one another, trying to get Facebook in some sort of trouble. Interesting to see how this will develop. Giant market-dominant companies like Facebook, Pfizer, and Comcast strategically hire senior government officials who can leverage their contacts for corporate gain. If we want to root out Washington corruption, that must end, and I've got a plan. She's got quite a message. So it'll be interesting. She may give old Trump a run for her money, but I don't think the Democratic Party is going to be too happy about her taking the lead. 2 years after serving as George W. Bush's Deputy Chief of Staff for Policy, Joel Kaplan was hired by Facebook as its Vice President for U.S. Public Policy. Since he was hired, Facebook spent over $71 million on lobbying, nearly 100 times what it had spent before Kaplan joined. Here's a look at our charts. SPY ETF is at all-time highs. I'm looking for a range of 315 to 330 as a topping point or a new danger zone if we get all these bullish things in place, which would be Fed becoming dovish tomorrow, potentially continuing to keep the ease in December 11th at their next meeting, and then the phase 1 trade deal. And then if we get a little extra cash injection from China, I think we'll see quite a stock market rally in both EEM and the SPY. So potentially we have a 5 to 10% run up from here on the SPY, and potentially a 10 to 20% run up on emerging markets, just for it to get back to its all-time highs of 2017. TLT, on the other hand, should gradually travel higher as the federal funds rate travels lower. Now, if we go back to that chart where is the economy really strong? Is this just a mid-cycle adjustment? If that is really the case and everything's fine and we don't have a global slowdown, then the TLT might be in some trouble. But I don't think that's the case, and I think we're going to see these central banks have to remain very dovish for a considerable amount of time, at least 1 to 2 years, as there's a dramatic slowdown in China. So this is bullish for GDX. We got 2 of the magic ingredients for gold. We just need the third. So the first is lowering rates. We've got that clearly globally. 2, we have the money printing. That's just started up in the last few months. So all the people who are buying gold all year have been predicting that this would happen. It's happening, and now they're being highly rewarded. We were playing GLD this whole time and have recently switched to GDX. Now, in terms of wanting to be bearish on the stock market, I'm going to have a hard time betting down for a very long period of time. Without this ETF pulling back significantly, this is the investment grade bond fund. It's just a measurement of how cheap credit is for corporations. If they can get free credit and just buy back their own stock, they can goose their earnings per share, and they can keep blowing up this bubble. And this is at the same time that insiders are selling at a rapid pace. So until this chart cracks and this chart cracks, the credit market is going to be very accommodative for corporations to buy back their own stocks. And we don't have fiscal policy here in the U.S. That's going to hurt GDP or the earnings on these companies. So we have very large deficits, which will continue to push through the system and give us decent prints. And with that said, our print this last quarter, or expected this quarter, is now down to 1.6. So we're not growing at a rapid pace anymore, and more reason to believe the Fed will have to remain relatively dovish for not just this November 1st meeting, but also, or rather October 30th meeting, but also into the future and into next year. Now, part of the phase 1 trade deal is to peg a exchange rate on the dollar against the yuan, and I have been dying to short their currency, expecting the trade deal to break down. It looks like they may create a phase 1 trade deal, but the phase 2 and phase 3 seem highly unlikely. So we're going to hold off on shorting that currency until we do see the trade talks break down. But you can see their clear strategy is to devalue the currency before they try to take on real fiscal policy in China and clean up all the problems they have. So also, every time we announce a new tariff, they devalue their currency to offset that cost. And that's causing a ripple effect in all the other emerging markets, forcing them to devalue their currencies to keep their exchange rates fair for all their trade. Here's a look at oil, which I believe will start to drift higher if all these things come into play. So we get the dovish Fed, we get the phase 1 trade deal. Oil prices are likely headed gradually higher until it starts to create some inflationary pressures, which is really what will be the final prick in the bubble if the U.S.-China trade dispute doesn't do it first. Gold is at elevated prices. This is what happens when you print lots of money all around the world. The relative value of gold travels higher. Here's the German bond, which, if you believe it's corrected and no more downside, then we would want to get out of the TLT. I don't think that's the case. I think this is a small little relief rally, but the general trend is all the central banks are lowering rates, and that's a gravitational pull on these bonds to drive their yields lower and the bond prices higher. And so we can see the high correlation of the U.S. Treasury to the German Treasury, and if China is really in some pain, Germany is one of their key trading partners, and we'll see it in Germany's numbers first, as they have much more open numbers. Here's that dollar index. So we can see the same trouble. Emerging markets are weak, forcing the dollar to remain strong even as we're printing $200 billion and now on our third rate cut. That should be dramatically lowering the exchange rate of the dollar, but it's still not happening. And meanwhile, same picture for Bitcoin and Ethereum as gold. We have, of our 10% allocation in gold, we actually took 2% of that and put 1% in Bitcoin and 1% in Ethereum. And that's treated us very well this year. And will continue to do so until the big picture changes. All right, guys, that's a wrap for today's presentation. Don't forget we have our paid webinar tomorrow and our freebie webinar Thursday. Let's see if we have any questions from the crew. We've got a normal crew joining us every day. I really appreciate you guys joining us live. Hope you enjoyed the content. Any questions out there, Tom, Ron, John?